You are now able to see the new notes master for FDRM. If you are not, then you let me know. Okay, we will open this as well. We are now looking at the session notes. Right. Okay, so we will just, what we're going to do is, I'll just quickly give you a rundown of the order book that I was discussing. Now here you can see an order book. I mean, actually, this is not an order book yet. I'm just going to play this video. The audio is not going to be very good, but the goal is to just see. Euro now, let's focus on the euro. This is the top of the book. Let me just see where the. I'll just cancel this. Right. Okay, guys, let's look at this now. Okay, now we are looking at the euro. Okay, so I'm going to freeze this video here. You can see this here. So this is what we were trying to show you here. This is an example of the euro. And all we are saying is that when you look at, you can do this on any of your IVTWS stickers. So here, these are the order quantities and these are the order prices. So this means here that there's, I don't know if you can see the 7 million. So this is 7 million and the price is 117.68, which means there's a bid for, some guy is looking to buy 7 million euros at 117.68. Here you can see 7.5 million at 117.70, which means this is on the offer side. Some guy is looking to sell 7.5 million euro at 17.70. Okay, so that's what we were just mentioning, that this is an example of an order book where you see the entire set of orders stacked up together. And this can be seen either at the level of, we showed you the other material the other day, which is under DP5. We showed you this technology architecture of trading. We showed you that there are three important points to look at in the software arrangement. So one you have is the trader who is originating the trades. Then you have the brokers. So this is order books and market depth, but here. So this order book display that you see here, this kind of order book display can be seen either at the level of the broker or at the level of the exchange. Okay, so the exchange contains the highest number of participants. There are many, many brokers, and each broker has many customers. Okay, so at the exchange level, you see the maximum number of players, and you can see this order book display either at the level of the exchange or at the level of the broker, in which where the broker is showing you the number of trades that he has on his software for his customers only. So this is actually an example of the interactive brokers order book, because this FX anyway is an OTC market. So this is IB's order book. So but the main thing we want to understand is when you see an order book, you try to make sure you understand whether it's at the level of the broker or the level of the exchange. Okay, and then you just notice the top of the book, which is the best bid, which is the highest bid, and then the best offer, which is the lowest offer. These two, you will see it like in this display, it's like this. Okay, most order books will have some kind of similar display, and then you'll see the other orders stacked up and down here with the quantities written against the different prices. All right, so this is how it's done. And when we talked about spoofing, what we were essentially saying is that if a guy wants to basically push the price down, okay, if a dishonest trader wants to push the prices down, what he will do is, let's say he looks at the price now, it's around 69, 68, 60, 69, 69.5 is the top of the book, okay? These two, the best bid and offer is the top of the book, and the rest of it is called the full market depth, okay? Ideally, you want to see the full order book, and you have the full market depth. Otherwise, you have different levels of market depth. So here what you have is, yeah, what was I saying? Actually, I just got a little bit lost. But anyway, so this is what you have here. So the full, top of the book and the full market depth. And okay, I got a little bit lost. I was going to say something, but I forgot what I was going to say. But anyway, it doesn't matter. So this is what it is basically that we're.
Spoofing. Sir, you were telling about spoofing.
Oh yeah, yeah, correct. So very good. So spoofing, what happens is that you have a guy. Let's say I'm going to do some spoofing, and my objective is to actually push the price down. Okay, I see the price is 69, 69 and a half, and so my objective is to push it down to maybe 1760 or something. So actually, I want to buy. But like instead of placing a limit order, my thinking is similar to that guy who wants to place a limit order. I want to buy, but I don't want to buy at this level. I want to buy a little bit lower down. So ideally, I want to push the market price lower. So what I'm going to do if I'm a spoofer is at this level when the market is around 69, 69 and a half, maybe at 71 half or something like that. Okay, a little bit away from the market, I will place a massive sell order. Okay, and if it's layering, then there's another version of spoof. There's basically multiple spoofing at multiple price levels. That's known as layering. So if I'm spoofing, I'll place, let's say, a $10 billion or sell order at 71 half. Okay. So when somebody is looking at the order book, the other traders are looking at the order book, they will say, oh, look at this 5 million, 1 million, 7 million, etc. But oh my God, oh my God, look at this. There's a 70 at 71 half, there's a $10 billion sell order. This is a really big seller. I'm really afraid. Let me quickly sell whatever I have to sell and get out of here. So they start selling, and that puts downward pressure on the market price, and then it pushes it down to where I want it to be. And once the price declines to this level, then I will quickly cancel this order, and then I will buy it at the market at lower prices. That's what spoofing is. Okay. And if I do layering is nothing but spoofing at different price levels. So then I'll put $1 billion at 71 and a half, $2 billion at 72 and a half, and so on and so forth. It's just putting multiple sell orders at multiple price levels, the spoofing at multiple price levels. So that's basically what it is. I just wanted to show you this display of the order book. So this is an important thing also to understand, and the two terms, the top of the book and the full market depth. So you understand what kind of, when people use this kind of vocabulary in the markets, you know what they're talking about. Just want to give a quick introduction to that.
Why is it illegal? Because the trader can have his trade executed before he can cancel his trade, and that he also has a bigger risk than others. So
Yeah,
why is it illegal?
you're right. Actually, it should not be illegal. So there is actually a case of a trader, an Indian origin trader. Actually, the guy called Narendra Sarao. You can check it up on Google. So Narendra Sarao is actually an Indian origin guy based in the UK, and he was trading on US exchanges. I think on the S&P 500 futures contract. It's based out of London. I mean, somewhere in the UK, and they have actually, I think they have extradited him to the US to face trial because he placed a lot of orders, and he was a spoofer. And there was a big event called the flash crash in the US markets where prices crashed quite dramatically in a few minutes. And that was supposed to be based on misunderstanding about a lot of orders. A lot of sell orders suddenly hit the market and all that. So, but Siddharth's question is correct that this guy is not a risk-free enterprise, because while he wants to push the price down, puts a 71 and a half, $1 billion sell order. The problem is markets can move very, very fast. Okay. So what might happen suddenly, some news might hit the market, or even otherwise some big order might hit the market. Well, you can't control what others are doing. Okay. So what Siddharth is correctly pointing out is that the guy who's spoofing is also taking some risk, because suddenly if a big buy order hits the market, which you can't predict, this guy 71 and a half, $1 billion, maybe there's a $10 billion buy order which hits the market. So immediately all this stuff is going to get picked up. Okay. If a $10 billion buy order hits the market will start moving up. All these sell orders will get cleared. All of them will be executed. And even a 71 and a half, $1 billion sell order will be executed. So suddenly the guy will be short $1 billion, 1 billion euros actually, because this is euro. So the base currency is euro. In euro dollar FX, okay, the base currency is euro. So the euro amount will be trading here. So these 7 million, 7.5 million, these are all referring to euro amounts, okay? The base currency amount. So suddenly this guy will also get cleared, because you can't predict what will happen in the markets, and markets can move very, very fast, okay? You will not be able to react, which is one of the reasons why I tell you that, one of the reasons, there are many reasons for that. Never plan to watch your stop from outside, okay? I'm watching the market, because you may not be able to react fast enough. So that's why I always say stops must be always entered into the system. They must be resting inside the system, so that the system is watching it for you, and the system can react much faster than you can react. So that is correct. This guy faces this risk. So it should not be illegal actually, but Narendra Sarao, in his case, he was an algorithmic trader. So what happened was, in his algorithm, so problem is when you're doing algorithmic trading, everything is programmed. So they could actually see that, because if I'm not an algorithmic trader, if I'm what we call a discretionary trader, okay, or at least, execution is, manual execution, not by computers. So algorithmic means execution by computer. So if I'm manually executing a trade, I can always say that, you know what, I was not really trying to spoof. At this point, I was genuinely bearish on the market. So I placed a sell order at 71.5. But then when I saw that it was starting to go down, I changed my mind. And then a split second, I changed my mind and I decided to become a buyer. So it's kind of very difficult to prove in a court of law that I'm lying when I say this. But once you do algorithmic trading, it's all in your programs. So you can look at your program code and you can see that you did not have any plan to execute this order, because the program code actually will say that once the price goes down, you cancel this order. Okay, so that becomes much more incriminating. So the reason they still prosecute these people, the reason why what Siddharth is asking is a very good question actually, but the reason they make it illegal still is that this is a form of market manipulation actually, all right? So this is a form of market manipulation that they see. It is correct that there is a risk, but actually this goes back all the way to contract law. In contract law also there is a kind of a concept of fraud, where you enter into a contract which you have no intention of fulfilling. Okay, like I might sign a job offer with some university, but knowing full well that I have no intention of taking up that job offer. When I'm entering into the contract itself, I have no intention of fulfilling the contract. So that is basically known as a fraud. So this will come under that kind of thinking. So in many countries, they have made this illegal, this kind of spoofing activity. So that's basically it. So just to recap a little bit, hopefully the picture is a little bit clearer from what we did the other day. All right, so we'll just move on from any questions so far on this point. Okay, I'll just close this.
Sir.
Yeah.
Sir, can you repeat one more time?
Which one?
Sir, the manipulation part.
Yeah, so the manipulation is basically because this guy was, see, you place an order at a particular price and you have no intention of executing that order. That's why it's called, and your objective in placing that order is really to scare other traders. Okay. That's why you're manipulating, because normally what we expect is when you have an order book, when you place an order, what we expect is that you have an intention to execute that order, at least at that point. The problem with Narendra Sarao and other people who are doing spoofing is even at the time that they place the order, they have no intention of executing that order. And sometimes for algorithmic traders, that intention can be detected in their program code. So that's why it's called manipulation, because I'm actually trying to influence other traders, and I have no intention of executing my orders, which is basically society does not consider that acceptable. They require that when you place an order, you must actually, it's almost like almost semi-entering into a contract. So you must have good intent. You must be doing good faith contracting. So you are basically not acting in good faith. So that's why they call it manipulation, and you're trying to influence the behavior of others. You're deceiving people actually. You're misleading people. That's why it's called manipulation. You're misleading people. It's a bit like sometimes when if you go looking for a house, the broker might tell you that you better make an offer on this house right now because 3 people have already seen it and they are going to make offers today. Some of that information may not be true, but they will just say it to put pressure on the customer. So it's also a form of manipulation because you're saying something which is not true. Here you're making a representation that you will be selling so many $1.5–1 billion, but you're actually not, you have no intention of doing that. No intention of carrying out that stated intention.
Okay, sir.
Sir, what is a Harshit Mehta case then? Is it related to that?
Harshit Mehta cases, you might see it in if you read your, remember please guys, at this point, I'll remind you once again, I don't have time to discuss Indian markets with you specifically, but it is your responsibility to, have you guys got your Hal and Basu book? Have you received your Hal and Basu textbook? Anyway, you will get it.
Yes, sir. Yes, sir. Yes, sir. We received derivatives.
So please make sure in all your 3 finance courses, the textbooks that I will give you, they will contain, it is your responsibility to find these subsections and detect them. They are easily detectable from the contents section. They will have some section on, because all these books have an Indian author, and the Indian author basically adds some information on Indian markets. So it's your responsibility to read the material on Indian markets and be informed about what is going on in India. Okay, so that's basically what is required. So you must do it, and if you have any questions from there, then you can ask me and then I can explain it in the class. Generally, that information is just in the nature of information that, West Bengal has 18 districts, or Bihar has, 6 major cities. This is just information. There is no analytical concept involved here. So it's mostly in the nature of information, but if there is something to understand as a concept, I'll explain it to you. You have to ask me because I don't have time to do this material, in the class. Class is spent on explaining concepts. So I'm not going to explain information and give you information in the class. It's not a good way to use the class time. So a Harshit Mehta case, which Sachin is asking about, that is actually a different case. That's an example of, what we do. They were actually using fake broker receipts. Okay, they were called BRs, broker receipts. And it was an example. It is connected to repo-based borrowing. Okay, and you know what the Reserve Bank does, a repo market. So these banks and all were borrowing based on collateral of government securities, but essentially what it was those collateral receipts were fake, in the sense that, let's say I am Punjab National Bank and I'm borrowing from some other bank, okay, and I'm providing a securities collateral where I'm saying that, okay, I'm borrowing this amount of money against 10,000 crores of Government of India securities, and these are being held by brokers. So these securities were being held by brokers, and the brokers were giving receipts saying, yes, Punjab National Bank does indeed have 10,000 crores of government securities, and Harshit Mehta brokerage house is holding those securities. But actually they were not holding those securities. There was no such security. It was just a total lie. So because the brokers were involved in issuing these receipts, so people were basically borrowing supposedly against collateral, but the collateral did not exist. So it was actually clean borrowing. So, and this money, what it was being done was, this kind of free money or easy money was being used to pump it into the stock market and buy stocks. So when stocks collapsed, there was a problem with the loan system. So this is basically what the Harshit Mehta scam was, that it was basically about fake BRs. Okay, so that's how it was. So it's a slightly different kind of situation. not connected to spoofing as such, right? So you can read up more on it, and maybe sometime later, once we understand repos, we can understand this situation a little better, I think, right? Okay, so does that make sense to you, Sachin? At least a little bit.
Yes, sir.
Okay, so that's a different thing from spoofing. Okay, so yeah,
Sir, I have one question, sir, not related to this.
yeah.
Sir, when we are bidding for any shares, sir, are the other investors also aware that how many shares I am bidding for? What is the lot size or something related to that?
No, they can see. They can't see this Harsh, right?
Yes, sir.
Yeah. So they can't see that Harsh Jindal is placing an order for 100 million shares of Cisco. But
Okay.
once you place the order, when they look at the order book, okay, if let's say
Yes.
you have placed an order at say 94.50, then
Yes.
they can see that there is an order, and if there is no other order at that price, they will see that there is an order to sell 100 million at 94.50. Okay, but when they look at the order book, they can see once your order is entered, it goes into the order book database. So anybody who is looking at the order book is going to be able to see that, but they won't see that that is Harsh Jindal's order.
Yes, sir.
Okay, so and there are also other concepts you can read more. If I've given you these links, under uh, IB links, if you want to study more, first you make sure you understand the basic order types. You go here and you open up the IB page. Actually, there are hundreds of order types, maybe not hundreds, but many, many order types. Okay, here,
Okay, sir.
there you can check on the IB website the different order types. Okay, there are many. There is also a concept of an iceberg, or one of the orders is the iceberg order, where icebergs, as you know, icebergs, Titanic and all that. What happens with icebergs? You get to see very little of the iceberg on the surface. Maybe only 10% of the iceberg is visible above the water. And underwater, there's a huge part of the iceberg. So you have iceberg orders also, where if you want to sell maybe 100 million shares, at a point of time in the order book, you show only 5 million. And once that 5 million is done, another 5 million appears, and so on and so forth until the whole 100 million is done. So there are many kinds of uh, algorithms that you can design for placing orders, and IB is very sophisticated when it comes to that. So you can go to the IB's web page and study the various order types. But in general, the answer to your question, they can't identify you by person as an individual. So only your broker will know that this order has come from Harsh Jindal, but that also they will not normally look at it unless there is some kind of problem and then there's an investigation and all that. Like in Narendra Sarao's case in the UK, they were able to identify him because the US authorities came looking for the trader. Okay, so they basically went to the broker, and because every trader has to go through some broker. So they found out the broker from where the orders came, and then they tried to identify who the order was. Because it's a criminal investigation, then the broker has to is obliged to provide the information. But unless that kind of a situation, normally they will not try to find out who the person is behind this order. Is this clear?
Yes, sir.
If you remember, when you place your orders on IB, there is a button called transmit.
Yes, sir.
So once you transmit that order, it goes into the order book. Until you hit transmit, nobody knows what you're planning to do. Once you hit transmit, it goes into the order books, but it is still not identifiable as order placed by Harsh Jindal. General public can't see it. Okay, they see only the price and the quantity. Okay, all right.
Yes.
So, as I said, you can go and inquire to go see the IB web page. Check the order types. There are many different order types. So those who are learning a little bit like on programming and all that, it's very useful. It's very useful, and it is mainly going to be useful in algorithmic trading. So in algorithmic trading, you use you have a wide variety of orders that you can place. So you can read more about them, but first make sure your fundamentals are clear. Market order, limit order, stop order, all that is clear to you, very clear about that. Okay, be very clear about that. Yeah. Okay, so let me set the alarm also. We have not set the alarm for the class. All right, we have that. Okay. Okay, so we have finished. I think we have finished DP5 now. We have, I think we went to that. Bracket orders you can inquire on your own. You can even practice. Bracket orders can be quite useful. But this project is over. You can do it even for options, okay? And then you have this technology architecture of trading. You can try to understand that. And what have I placed here actually? Okay, this is the note on the IB API. You can read that and understand. Order books and market depth. We have covered this. So since DP5 is over, we'll keep that. Now we'll go on to DP 6.1. Okay. So we'll go on to the example that we had given. All right. So now DP 6.1, let's understand what that is. So DP 6.1 is essentially exit with profit. Okay, so this is one of the questions that you have that, okay, so we gave that example where Sachin has bought at 11.5, he bought FCX, okay? And when he bought it at 11.5, he placed a stop over here around 975, okay? Because that was the highest low from which the new high had been made. When it went to 11.5, he bought it, okay? And initially he placed a stop over here. So the question is, and now the market has come all the way up to here. Now the question is, this is a 2-hour chart, okay? Let's assume he's using this, then that'll keep him in the market still. So all he does is, so in this kind of a display, at this level of zoom, this level of zoom in or zoom out, we only see, let's say we only want to see a few highs and lows. We see this low, we see this low, and we see this high. We choose not to see these highs. We say these are very small, okay? Or you can either see them, but let's say we see this low, this high, this low, high, low, high, low, and we don't see this one, this one, this one, we don't see. After this low, we only see this high, okay? And we see this low, well, we don't know if it's a low yet or not because the new high has not been made, but maybe this is going to be the low. So after he buys, so basically this is what we have, okay? So the question, so let's understand the decision problem. The decision problem is exit price with profit. So what is it actually? So a trader has bought this stock at 11.5. At that point, he placed the stop here. Now the market is a lot higher. So now almost it's about $17. Okay, 17.25. So now the question is for this trader is at what point should I exit this trade now that it's making a profit? At some point of time, I need to realize my profits. I need to crystallize my profits and lock in my profits by selling my long position. Okay, so that's the question. The question is at what point should I do that? All right. So that is the decision problem. So understand that this is also a decision problem. And many people, of course, do it. Many amateur traders, sometimes even professional traders, what they do is when they're dealing with this question, they just deal with it kind of in an arbitrary way. Okay, let's do it now. Let's just, okay, this is good. Lots of profit here. Let's just book it now. Let's book our profits. But this is not the right way to do it. There is a structured approach that you can bring to your trading. It's always better to have a very structured approach to your trading because that gives you a lot of control and it helps you to protect yourself. So, and it's a much more scientific approach as well. So there is actually a structured way to solve this. So there are two broad solutions to this problem. So remember the decision problem always. The decision question is, at what price, now that my trade is profitable, I can see the market is going up after I bought it and it keeps on going up. But at some point of time, I need to sell my long position and book my profits. And what is that price? At what price should I do that? Do I do it now at 17.25? Or what if after that it goes up a lot? Okay, maybe it goes up a lot and then I'm going to look like a fool because I sold it too early. All right. So maybe if I sell it at 17 and a half and it goes and breaks over $20, then I'm going to look like a fool. So should I wait here, or should I, should I sell it right now, or should I wait till a break above $20? So all these questions will arise in your mind, and how do you solve it? That's what we are discussing now. All right. So I will clean up these notes a little bit later, but we'll understand it basically. That BP1. Okay, there are two solutions. Okay, two. So let's call this first. There is the indirect versus direct solution. Now, indirect versus the first point we're discussing is indirect versus direct solution. Right. So we can make these a little bit later. Okay. So what do we mean by indirect solution? Let's discuss the indirect solution first. We can. All right. So indirect solution you have already discussed. So the indirect solution to this problem is the use of the trailing stop. So this I'm not going to discuss in great detail because we have already discussed it. Okay. If you remember from the past sessions, even here with this 4-hour display, I can still see everything I want to see. The same kind of, you can see here low, high, low, high, low, high, low, high, and maybe this is the low. So the trailing stop is, initially he buys it here, then he puts a stop over here. After the market goes up like this and makes this kind of formation, when the market rises above this high, a new high is made around here. Now the trader can see a new higher high, highest low from which a new high is made. So earlier it was this when he went along here, but now there is actually a higher low from which the new high is made, the latest high is made. So therefore he is able to move his stop from here to here. Okay. And now if the market goes straight above, makes a new high above this, then this will become the highest low from which a new high is made. And then the trader will shift his stop, will move his stop from here to here. Okay. Is everyone clear? You remember the trailing stop? Has everyone understood this?
Yes, sir.
Okay, good.
Yes, sir.
Okay. So trailing stop, this is an indirect way to solve this problem. Why do we say indirect? Because the concept of the stop comes to us from an examination of decision problem 6.2, which is exit price with loss. So we are calling it an indirect solution because we are actually not directly trying to solve this problem. We are using the same solution that we use for 6.2. We are using it to proxy the solution for 6.1. That's why I'm calling it an indirect solution. We're using the same technique from here, and we are just using it to proxy the solution for 6.1. That's why it's an indirect solution. And this, as I said, it's especially for stock markets and commodity markets, where you can have enormous trends for any kind of market actually. This is a pretty good system to use. Okay, this makes your system a little bit simpler. It makes it easier to manage, and you have one less decision problem to directly solve. Okay, 6.1 does not need to be directly solved. We are solving it indirectly. So this is actually quite a good solution. Okay, if you are thinking about applying it in your own trading, you can happily do it. Nothing will happen to you, and in fact, you'll be able to capture. This is the advantage of this solution, is that you are not expressing any view. Like when you look at, I've asked you to follow market commentary. So when you follow market commentary, you may very often find people making statements like, "Oh, the market is stoppish right now." Like for instance, if you look at the U.S. markets, especially look at the Nasdaq. Okay, so this is the pre-pandemic high. is the pandemic sell-off, and you see where the Nasdaq is today. So as the market was rising, you will see, if you look at the market commentary, they are all basically going against the market. They're saying, oh my God, the market is overvalued. It should not be here. The market is out of touch with the economic reality, this and that, whatever it is. But you can say whatever you want. But if the market is going up, that means it's going up. That's a reality you have to face. So a lot of these people might have, if they had gone long here, they might have just sold off here because they couldn't believe that in the middle of the pandemic, the stock market would go up so much. So the advantage of using a trailing stop is, if you look at this in closer, just looking at the Nasdaq itself, let's say this is a 4-hour chart. So if you look at a 60 minutes, you can see the rise from the pandemic more clearly. Okay. So those guys, if you look at the market commentary, it was very bearish. Okay, so if a guy had initially gone long somewhere here, let's say, as a new uptrend develops, okay, low, low, high. The moment you have a high higher than this, you have two highs, two lows. Second low higher than the first low, second high higher than the first high. So you got the basic start of an uptrend. So you can go long here. Okay, so and then you put the stop over here. So the advantage of using a trailing stop, okay, is that because it's very difficult to actually predict when a trend is going to end, and no amount of expertise will ever help you to solve this problem in a definitive way, okay, in the sense that many problems we have solved when it comes to hard science, we know how to solve problems. Like once SpaceX has figured out how to send a rocket into space and then bring that rocket back and land it on its back on a spaceship on a barge in the middle of the ocean. They, I think, failed once to do it, or maybe failed twice. By the time once they crack it the third time, they crack the problem. Okay, there's no need that they're never going to fail again once they've cracked the problem. This is what happens in science. Once you crack it, it's cracked forever, and other people can copy your solution and just save themselves the trouble. But in the markets, there is no level of expertise that will ever help you to predict when a trend is going to end. So the advantage of trailing stops is that instead of getting scared by all the commentary from all the so-called experts saying that, oh my God, the market is out of touch with reality, it should not be so high, it should collapse further, then maybe out of panic, you sell your position over here itself. Okay, so you bought it here, and then after a little bit of profit, you sell it off in panic, because what you're doing is actually you are applying a direct solution to 6.1 exit price with profit. You're actually applying a direct solution. Okay, and that's why direct solution means you directly try to determine when the market is going to turn around, and then you sell it or buy it at this point. Okay, so in this case of a long position. So this is the problem. If you get scared by market commentary, the problem with the direct solution is that you are making a determination. Obviously, if you're long over here and you're deciding to sell off over here, why are you selling? You obviously feel that the market is not going to go up anymore, all right? Because everybody is rational. If they are selling, I think I can conclude, if you were long from here and I see you selling it off here, I think I can safely conclude that your thinking is the market's not going to go up anymore, okay? That's why you're selling it off and booking your profits. Now, this is the problem with the direct solution, because you are making a determination that the market is not going to go up anymore. But in fact, nobody knows what's going to happen, okay? So the advantage of the trailing stop is that you do not make any judgment about when the market is going to go down. You allow the market to tell you that by breaking the trend. So if you're using a trailing stop, you won't get scared by all this market talk. You go long here, your stop is here. Then you see what's happening.
Sir?
Yeah. Yeah.
Sir, just like we read the spoofing, when in this case, when everyone's selling, when all people think, all investors think that market will not go up and everyone's selling the share. So the share price automatically goes down.
No, I mean, whether or not it goes down or goes up, that you will be able to see yourself. Okay. So that's why one of the things, I mean, whether or not that's a very general kind of question. So in general, you will not have, I mean, there is no general answer as such because it all depends. But what is happening, I mean, the whole approach in technical analysis is to just follow the price action. Okay. Price action means nothing but the movement of the price up and down. Okay. So all this is all price action because it's documenting the history of the price movement. How did the price move in the past? So what happens to the buying and selling, okay, and how it pushes the price around here and there, up and down. That's basically something that's happening. Okay, it's like life itself. You know, what will happen tomorrow, we don't really know, but when it happens, we will be able to see that this is happening. I don't know if I'm answering your question. I was not able to understand your question very well, but am I able to? Are you?
Yes, sir. Yes, sir. Yes, sir. Now I'm getting, sir.
Yeah. So whatever happens will happen, right? So in fact, the idea behind the trailing stop and the idea of the concept of trend, higher highs, higher lows, you understand why the trailing stop was placed here, because you went long here because you had the start of an uptrend, high, higher high, low, higher low. Minimum condition for starting an uptrend is satisfied. Okay, you go long here. You place the stop here because if the market goes below this, then the sequence of higher lows is destroyed. So the uptrend hypothesis is invalidated. And that's why your long position based on the hypothesis of a continuing uptrend is now no longer tenable, okay? No longer justifiable logically. So you have to surrender your position. That's why you place a stop here, right? Everyone's clear about this? This is your logic. So
Yes.
yeah, right. So basically, this is the logic of trend-based a technical approach where you do not directly try to solve the 6.1 decision problem. The advantage here, as you can see, the real life example, because even today, if you look at the market commentary, people are saying the market is overvalued. Okay, of course, as I said, what they really mean is that the market is overpriced relative to my understanding of fair value, my assessment of fair value. That's what they're trying to say essentially. But market may be overvalued, but the market is the market. Okay, it is what it is. So it's like saying, you know, the US Navy is more powerful than the Chinese Navy. Okay, you may agree with it, or you may not like it if you're Chinese, but it is what it is. Okay, so so that's basically it. So here the advantage is that you are not using your judgment about the market, and you are allowing this kind of a very objective method where the market goes up, keeps on going up. Now this is the low, first low, second low, third low, maybe fourth low, fifth low. Actually, maybe we are not, I'm just trying to make a point here. So third low, fourth low, fifth low, sixth low, seventh low, eighth low, ninth low, 10th low. Finally, this is broken over here. The 10th low is broken over here, okay, on this day, 21st September. So instead of getting out in a panic around here or around here, the advantage of the trailing stop is when you go long first here, you place the stop here. When the market rises to this level, you raise your stop from here to here. Then you raise your stop to here. Then you raise it here, then here, then here, then here, then here, then here. All of these are never broken. And the market keeps going higher. And your profit keeps building up, unrealized P&L. Finally, this point, okay, this breaks it here, and then you get out. So which means you went long over here, and you get out over here. Okay, so that's a big chunk of profit. So this advantage of a trailing stop is that it keeps you in the market for when you have enormous trends. Okay, it keeps you in the market. But the disadvantage, of course, is that when you finally get stopped, okay, over here, and this one breaks, so you get stopped somewhere around here. So what happens is the disadvantage is now you feel, okay, that well, I could have actually booked my profit over here, but instead of that, I'm getting stopped out here. So all this profit from here to here, I've lost. Okay, I've kept the money on the table. I kept my money on the table and I lost that money. So now this is something that you can't, this kind of trade-off can't be eliminated. Okay, so everything you do has some kind of positive and negative. All right. So if you focus a lot on your studies, in your postgraduate, you don't do too much extracurricular activity, you stop playing cricket, stop doing your, music practice or your yoga practice and this and that. Yes, of course, you miss out on the fun of all those things, but the other advantage that you have is that you get to give maximum concentration to your studies and you're able to develop yourself as a business student. So everything you do in life has trade-offs, and so this is no different. So the trade-off involved in the trading stop is that it keeps you in the market for enormous price moves, which you can get in equities and commodities especially. Okay. So it keeps you in the market, and the negative that the downside of this kind of approach is that when you finally get stopped, you may have given up a lot of paper profit. So this is all paper profit, and then it comes down and stops you out over here. So you've given up this profit, but there's nothing, you can never get away from this trade-off. So you have to take a decision at a strategic level that I believe that this is a good system, a good method in the long run. So yes, sometimes I will feel that I'm leaving a lot of money on the table and losing all this paper profit when I finally get stopped. But that is a cost of using this method, and it is outweighed by the benefits that I derive from using this method. Is everyone clear what we're talking about? This is an important,
Yes, sir.
yeah, so important to understand this. I think let's write the pros and cons, because these are actual decisions you will be taking in your life. Okay. So for instance, now after many years of trading, many years ago, I had moved to this system. So I don't use take profits. I always use only trading stops. So I use this method, and sometimes it comes down and breaks the system. But if you are committed to this method, you will not get disturbed by that. Okay. So if you have it's just you choose to apply this strategy. Okay. So keeps trader in the market for strong trend moves. Okay, this is what we mean, that you don't get anticipate changes. Okay, market tells you when to exit by breaking trailing stop levels. Okay, so what I mean by this is trailing stop trigger levels. Okay, pros here. Trailing stop trigger level means here. What I mean by that is, instead of exiting subjectively here or something, I decide that the market is not going to go up anymore. I don't take that decision. I just use trailing stops, and I move my stop. And this is finally when the market tells me to exit, because it breaks my trailing stop trigger. This is my trailing stop trigger, and it breaks that. And so that's what I'm writing here. Okay. All right, so this is the indirect solution, trailing stops. Very important actually to understand. And when you feel comfortable, you can start. Then you can apply this method. It's a very safe method actually, and it's also important to capture large profits. Cons, okay, that trader. This is called leaving money on the table. All right, I don't know if I told you guys, I'm just remembering a book actually. I'm just going to mention it to you. Very important book. I think you can find, I don't know if it's in my finance reference folder, but you can look for it. I think you'll get it on the internet. There is a book, and we are doing the DP, today we're doing DP6. We may be doing DP 6.1. Okay. That's what we're doing today. Okay, as a aside, I'll just mention this book. Okay, the book is called The Disciplined Trader. You can look this up. I think you'll find the PDF on the internet. You can look at it. It's a very important book on trading psychology. It talks about many things, and it talks about 4 major fears of trading. 4 major fears of the trader. So, and one of those fears is actually what we call the fear of leaving money on the table. Okay. So one of the things is that people are not able to use this trading stop method because they can't handle this. When they use a trading stop and the market goes up so much and then it comes down and hits their stop here, and they feel so traumatized by the fact that all this profit that they had, all of that got wiped out. They can't handle it emotionally. So that's why this is called the fear of leaving money. So they don't end up using this method. They try to actively take profits. And of course, that has its own downside. So this is called fear of leaving money on the table. So I remembered that fear, and that's why I remember this book by Mark Douglas. Very nice book. So you can check it out. Okay, trader leaves money on the table. This is the basic problem. This is only con. Okay.
Sir,
Yeah.
sir, can you tell what is this trader leaves money on the table? So what is the
Yeah.
meaning?
Yeah. Okay. Good. Very good. Good. I'm glad that you're asking questions. Whenever you have any doubt about anything, you have to ask questions. Okay. You have comma, full stop. Also, if you don't understand, you have to ask. So, trader leaving money on the table is just this. The example is when you look at it finally when it gets stopped. Now, what is happening? The trader went long over here. Okay. Initially put a stop here. Then he moved the stop from here to here to here to here, etc. So it's finally a stop is over here. So trader remains long. Okay, he went long at this price, maybe 195, and he is still long, and the price goes all the way up to say some 305. Okay, so he sees a maximum profit of 305 from 305 minus 195. Okay, he sees all this maximum profit and leaving money on the table, but his trailing stop is actually only here. Okay, this 265 here, 265. That's where his trading stop is, at this level, 265. Because he's following the
Yes.
stop method. He's not actively choosing to exit by manually selecting a level to exit. Okay. So this is what is meant by, so all this money from 265 to 305. Okay. All this money, he's leaving this money on the table because as we saw eventually what happened, this trailing stop got taken out. Okay. So then from 265 to 305, this money he left it on the table by not taking his profit here or here or here or here or here as it was climbing. He could have actively taken profit, but since he is not trying to actively take profit, his policy is to use a trailing stop. He leaves a stop over here. He does not use any targeted take profit. So he has left this money on the table. Leaving money on the table means, it's like it's a term from gambling, actually, from poker and games like that, where it's now become generally used to describe situations where you are leaving some profit opportunities on the table, and leaving money means the gambler leaves money on the table and walks away. Okay, so you are giving up basically. You are sacrificing, or it's generally used in a negative sense that you're sacrificing or you're being stupid. You are leaving that money is available on the table and you're leaving it there and going out. So that's what it means. Is this clearer now?
Yes. Sir, this will happen in case of every uptrend.
Every up and every downtrend also.
Downtrend, sir. How in downtrend?
Okay, let's look at some market where there's a downtrend. Let's see.
In downtrend where the trail stop will be the high.
Correct, correct.
Sir,
Yeah.
But if if we exited using trailing stops,
Yeah.
and then the downtrend followed and we were in long position, so it will be a profit for us, na? So
Correct.
how the
Correct.
so
Yeah, go ahead.
yeah, so my point is the con we that the point we are mentioning, that traders leave money on the table. So if in the scenario I am talking about, there will be a profit to us, so how does we are leaving or sacrificing our money? Basically, we saved us from loss.
Yeah, you're saying that since the trader is making a net profit, why is it being called a con? Is that what you're saying?
Yes, sir. Yes, sir.
No, it's a con only because the trader sees, like going back to the question earlier about the leaving money on the table, okay, that the question is that the trader is able to see that it went up all the way to 305, okay? So the trader is watching the market, but he leaves the stop at 265, okay? Because that's the system, that's the method. The method is saying the stop should now be at 265. And so he leaves the money on the table in the sense that, all the profit from 305 to 265, this profit is lost. This paper profit, this is called a paper profit. When you haven't booked it, unrealized profits are called paper profits or paper.
Okay.
So it's a con because on paper, it looks like, on the surface, it looks like you're leaving all this profit opportunity on the table, and you're leaving your stop over here, and you're not taking the opportunity to take profit over here actively. That's why it's a con in that sense, that you will never capture, let's put it this way. This method will never allow you to sell, buy at the lowest. No, this should be highest.
So,
So
so basically, it is saying that we have a unrealized profit.
yeah, I'm just explaining this. Let me answer this question first. So leaving money on this method, basically it's a con because it never allows you to sell, buy at the highest or lowest price. It never allows you to sell at the highest price, never allows you to buy at the lowest price. That's what it meant by the con, okay? It's a con because you could have, sometimes you are able to sell at the high and buy at the low, okay? It happens sometimes. So with this method, you're guaranteed never to be able to do that because you're using trailing stops. And they are called trailing because they follow the market. Okay? As the market keeps moving up, the stop keeps moving up. Here, here, here. They are following the market, but they are trailing. But trailing, the other meaning of trailing means to follow, but it also means to follow a little bit behind. Okay? So Usain Bolt is leading the race, and the number 2 guy is trailing him by maybe half a millisecond or something like that. So he is following him, but he's a little bit behind. Okay. So in this sense, that it's a con because you are never going to be able to sell at the perfect high, by definition. This method ensures that you can never sell at the perfect high. You can never buy at the lowest price. Okay, now before I move on. So Mitali, does it answer your question?
Yes, sir.
So now you understand what we mean by that. Yeah. But you're right. That is in fact what you're saying is you are actually emphasizing the pro. Okay. You're actually saying that by using this method, the guy who went long over here is able to keep himself in the market all the way up to here and finally get stopped over here. So he's able to capture this huge profit.
Yes, sir. Yes, sir.
So you're actually also hitting at the pro part of it. And that's what I was emphasizing, that using this trailing stop, you can remain in the market when you have enormous trends. Okay, huge trend moves when you get that. Like if you look at Amazon, for instance, also enormous moves. Amazon, a lot of tech stocks. Okay? If you look at these, see how enormous these moves are. Okay, so you remain in the market for these massive trend moves. And that's basically the advantage of the trade. Yeah, sorry. Next question. Yeah, after Mitali, somebody was asking a question. There were two more questions. I
Yes,
think.
sir.
Go ahead.
Sir, can you show the graph, the
Yeah.
previous graph?
Okay. Should we go back to the Nasdaq?
Yes, sir. So this graph. Sir, can you show the 60 minute? Yes, sir. Sir, suppose if the investor again want to go long, he will have to wait until the previous high will break, or he will start from there.
Well, there are two options here. Let's look at it. Now let's focus in on, so what Vipul is asking is, okay, we understand this guy went long here, kept on using a trailing stop, and finally his trailing stop was here when he got stopped out. So the guy gets stopped out here, 21st September.
Yes,
Now,
sir.
when will he go long again? That's what he's asking. Okay. So let's go into this part and just use a 15-minute chart to zoom into this part. Okay, so we can see this a little better now. This was the trailing stop where he gets stopped out. Okay, there are two answers to this. One, as Vipul has correctly pointed out, one option is for the guy to wait. The question now is, Vipul's question is, now that he has been stopped out of his long positions, when will he go long again? So one answer to that is, simple answer, probably the better answer, is as soon. Now, why did he get out? Because the uptrend was neutralized. If you go back to the 60 minutes, okay, he's following this uptrend, and on this degree, he's following these highs and lows. And once this low breaks for the first time, the uptrend is neutralized. So if the uptrend is neutralized, he cannot justify remaining long anymore. So he exits his position. Okay. Now, as he says, new high is made. Now what happens? Again, on a slightly larger degree, the uptrend actually has resumed. So if it has resumed on a slightly larger degree, then obviously it has resumed on this degree also. All right. Because there will be, if you look at this degree of movement, high, lower, low, high, 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 high here, high here, high. This is already happening at this stage. Okay. So if this goes above this high, okay, new high is made, all-time high, then obviously there's a larger degree of trend already beginning, okay, or continuing. And so the smaller degree of trend is dominated by the larger degree of trend. Remember this principle which we had discussed. One of the characteristics of trends, that the smaller cycles are dominated by the larger cycles. Okay, so it is quite obvious, obviously. So, so now what will happen is, so one simple answer to Vipul's question is, he should wait for a new high to be made, and then he can go long again. So like right now, for instance, if it goes up from here, okay, he can do that. If we go back to the 15-minute chart, this is our all-time high. And if, let's say from here itself, so this is the low so far after this high. So this is around, say, 286 or something like that, 286. So from here, let's say next morning, it wakes up on Monday morning and they shoot up above this to a new high, okay? Then what happens? He can again go long here at a new, as soon as the new high is made, and he can put a stop over here because there is a smaller trend developing here. Low, higher low, high, new high, higher high, again low. Then this will become the new highest low. If it shoots up on Monday morning straight from here, this will become the new high. He can place the stop here, or he can place the stop here. Either way, depends on what degree of zoom out or zoom in you're looking at. Okay, both are okay. This is a smaller stop, and this is a wider stop. So you can use either of them. So that's the first answer to Vipul's question. When will he go long again? This is one. Second is, he can also use the mean reversion philosophy that we had discussed earlier, where the mean reversion guy looks at the higher degree trend is up. Okay, so the higher degree trend is up, but maybe you're using a slightly smaller trading time frame. Okay, maybe this is not okay. This is not the right time frame actually. Yeah. So in the mean reversion approach, now this is your trading time frame, the 15-minute chart, and maybe this is around from 19 June. Okay, 19 June. So June, July, August, September, August, about 4 months. Okay, so 4 months is your trading time frame, and the earlier view that we had is many years. This is from July 19. So about yeah, slightly more than a year is your long-term picture. This is your big picture. The big picture is showing an uptrend, but a neutralized uptrend. Okay, and in the small picture, you have this. So the other way for him to go long is to believe in the long-term uptrend. Okay, and if there's any kind of neutralization of the short-term downtrend, so he'll be looking at the short-term downtrend, and he sees this, and he sees this coming down. So as soon as this high is broken, you have a neutralization of the short-term downtrend. Okay, so when you take a mean reversion view on this kind of chart, you look at this downtrend that's coming from here, and you believe that this is not sustainable because you're a mean reversion player. Okay, and you want to go long, and you also have the clearance from the big picture. You've seen that the big picture trend is up, so you can use mean reversion on your trading time frame, and then you see this declining declining pattern, short-term downtrend, but you don't believe in it because you're a mean reversion player. And as soon as the short-term downtrend is neutralized, which means basically break of this, on a break of this, because this is high, 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 low, 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 and low. As soon as this breaks, the sequence of lower highs is broken. So this short-term downtrend is neutralized. So the second answer to Vipul's question is, first answer is he can wait for a break of this. Second answer is he can apply mean reversion here, and he can wait for a break of this. In this case, he will go long as soon as this breaks, or somewhere around this 1st of October. And then when he goes long here, he should use a stop over here. Because if he's saying he's going long, means he's saying the short-term downtrend is over. If it's over, well, it started from here, and if it's over, it has to be over at the lowest point. That must be here. So when he goes long here, puts a stop over here, because if the market drops below this, that invalidates his view that this short-term decline from here is over, because it's going below this, which means it's making a lower low, which means the downtrend is continuing. Okay, so that's why the stop needs to be here. So he can. So the second answer to Vipul's question is he can also go long on a break of this short-term high, lowest high from which a new low is made. So does that answer your question, Vipul?
Sir, which is the most effective decision? Like, sir, we have to make a decision at some point.
Yeah. So here actually there is no objective method to choose between the two options. Here you have to use your judgment. You can use it actually, and I think it's also related to the time frame that you are keeping as your primary trading time frame. So you have to choose the answer to this. There is no correct answer here. The important thing to notice is your trading time frame and your big picture filter. You should keep them constant. Don't keep changing it. So the choice that you're talking about here, now which one should we choose? That depends. If your main trading time frame is something like this time frame, okay? So your trading time frame is something like this, is what? 18th August, September, October, okay? 18th August, September, 2 months. If this is your trading time frame, then you can use this method, okay? But if your trading time frame is much bigger, remember trading time frame is the small picture and the big picture is the filter. So you can't go against the filter, all right? So if your trading time frame tells you to sell, here you can't sell because the big picture, when you look at the big picture is actually up. So you can't sell here because the big picture trend is up. So you can't go against the big picture. So It depends on your, now if this is your trading time frame and your big picture maybe is even bigger than this, okay? So if this is your trading time frame, then in that case you would be using this method, okay? Because you almost can't see these highs and lows because they're very small, okay? So maybe you can't see this breakdown here because it's not sufficiently well defined in this time frame. So the answer to the question of which one should I choose, given the two options for going long again, the answer is really depends on what kind of trading time frame you have. What is the data range of the trading time frame that you're looking at? Okay, and again, there is no right answer on that. It depends on your comfort level. But what I would definitely say is that once you have chosen it, don't keep changing it left, right, and center every day. Maybe after 6 months you can review, or after 1 quarter you can review it and say, okay, maybe I should not be using 3 months and 1 year. Maybe I should use, 5 days and 3 months. You can do a review once a quarter or something, but don't keep changing the time frame, every second day. That will create problems. Yeah, does that?
Yes, sir. Sir, actually, this is the main problem which we face in the trading.
Yeah. So yeah, so you're just learning. So this is not as I said, this is not, we have thrown you in the water without teaching you how to swim. Now, after you've been thrown in the water, the teacher is reading from the side of the swimming pool. The teacher is reading you some books on how to swim. So this is what is going on because right sequence, the schedule, the time, we don't have enough time. Ideally, as I said, I would be teaching you all this in the first year. And then in the second year, we would only do projects. And then we'll only be discussing the problems that come up while you're doing the project. Okay. Like some of the questions that you just asked. These are the kind of problems we could ideally be discussing in a second year situation. But as you know that we have all kinds of problems, AICT, this and that. So we are operating within some constraints. So not much we can do about it. Yes, Mithali. So does it answer your question, Vipul?
Yes, sir.
So this is something this is why I make you do these projects, you see. So that's another thing that if you notice, I don't know, you can inform me. Please, in fact, I would definitely ask you guys to, if you come to know of other institutes where they're doing this kind of project with live prices and stuff. From what I've heard from your seniors, not many institutes are using this. Even MDI and all these places, they don't use all this. So because they have friends who are studying there. So you can let me know. But I think the reason I do all these things is because I think these are the things that you guys really need to know and get exposure to in terms of your actual training for operating in the real world. So this actually, I invest a lot of time in getting these kind of projects up and running, selecting the tickers and all that. So the reason I do that is obviously all this. So again, going back to the criticism I heard during our faculty meeting. So the emotional commitment to the welfare of the students is also to be seen in the effort the faculty puts into creating the material, teaching the students in the right way. So all that goes into the preparation of students. Okay, we don't really spend much time. I don't spend time, actively asking about your emotional state. But if you have any problems, you can always contact me. So this is the thing. So basically, the reason I do all this, what Vipul is saying is very correct, that these are the problems you're facing. And this is the objective of making you do these kind of projects. That I want to put you in a situation where you're having to operate just like you would operate in the real world. And then you face these kind of problems and how do you deal with them? That is what you're supposed to learn. At least you're getting a preview of what will happen in the real world, right? And that is how you'll eventually learn. Okay. And there is no perfect solution here. In many areas of trading, there is no perfect solution. No matter how much, as I said here, all the experts in the world, most of them are saying that, oh my God, the market is overvalued. It can't go up anymore, but the market keeps going up. So there is no expertise in financial markets. It's very difficult actually. But you can have expertise in physics and chemistry. Those things have real value because once you crack the problem, it's cracked forever. So here you can't, most of the big problems you can never crack. You are just basically, like a blind man in a room. You are just feeling yourself around and just hoping that you don't get shot. So this is how it works. But but even with this kind of uncertainty, you can still achieve a lot if you follow a structured method. Okay, it doesn't mean that the situation is hopeless, and that's what we are hoping to study today in these sessions. How to structure out your decision making, make your decisions very logically consistent. Okay, so that you have some kind of structure in your whole operations. Okay, yes, Mitali, you had a question, I think.
No, sir, just I was talking about the Vipul's point that can be to the solution, we can go for a long-term view of the company and then decide what we have to do.
No, so this,
Like for,
yeah, so long term, short term is all subjective, and so you have to as I said, you can use those two time. Well, I've given you a simple framework, okay, which is you use two time frames. So you can use this as your trading time frame, maybe. So August from maybe this is from July actually, okay. So August, September, October, 3 months. This is a 3 month time frame. If this is your trading time frame, then you can make maybe the big picture. This is your big picture filter. Okay, so this is around from 16 or so. So 17, 18, 19, 20. So 4 years. Okay, so that was like 3 months and the 4 years. I'm just giving an example. Okay, so what I suggested is you take two time frames. Okay, to keep it simple. You can also take multiple time frames. I just wanted to keep it simple while introducing the idea of a filter, long-term filter. So you have a trading time frame, and this is your long-term filter, and this is your trading time frame, right? So now how long this should be and how long the filter should be, that you can choose between. That is for you to choose. But I have suggested that you use a two time frame approach. Is this clear?
yes, sir.
So what it is that you figure out for yourself, as I said, you can have a quarterly review or even a monthly review. If you're trading very actively, you can do a review monthly also, that what should be my time frames. Okay, but what I have said is don't keep changing once a day from today, this month, 1 month and 1 month and 5 days, tomorrow 3 months and 1 month. Don't keep changing like that on a day-to-day basis. Okay, so that's what we said. All right. Okay, any other questions at this stage? Okay, so this is where we are now. This is the indirect solution of the trailing stop. Okay, it's a very important method actually, and market tells you when to exit. This is another thing. Trading system is simpler. It's simpler because the 6.1 is never being directly solved. You are just using the solution for 6.2 and proxying it to solve 6.1. So you have one less DP to solve. That's why the system is simpler. And this is a very important thing in life in general. You should always learn to distrust things which are very complex. Like one example of the very complex is that proctoring system that we looked at. Okay, so I have this instinct. So I'll just take 2 minutes. I think it's important for you to also understand this. Simplicity is a very big deal. Okay, when you make decisions in life, I'll just take 2 minutes to finish off. Okay, so I'll just give you an example of some system that many of you have exposure to, the proctoring system. Okay, the moment I have an instinct for looking at systems and looking at complexity and becoming very wary of complexity. The moment I saw that system, I felt that this is overly complex. So in life in general, you should always be, when you're looking at solutions, okay, not just technology, but everywhere else. If something is very complex, you should have a suspicion about it. Good systems should be very simple, actually. So this is something that I just wanted to highlight for you guys, that this is a simpler trading system, and simplicity has great value. In general, you should always select things which are simpler than things which are, as opposed to things which are more complex. Okay, So we have only one discussion. Actually, today we had only one discussion, the use of trailing stops. But still, it's an important discussion. If you have absorbed everything and we had a lot of questions, then that's a successful session. Okay. All right. So okay. So we'll have a next session is on Monday. Okay. I hope everybody has managed to make their submissions. I haven't graded it yet. So okay, guys. So I'll see you guys in the next class. So whoever class is dismissed now. And if somebody has a question, they can stay back. The rest of you can go. Enjoy your lunch.
So, sir, actually, I wanted to talk regarding my project. So, when I downloaded the files, hello, I'm audible.
Yeah.
So when I downloaded the files, there were only those. There was only those stickers that you have given to us. The iBot stickers which were showing that day, they were not in the file and they were not even included in the profit or loss.
That's fine.
So,
You have
so I don't need to make any changes. It seems to me that it's perfectly fine. It's just iBot feature which was working.
okay, fine, no problem. Yeah, in any
Yes.
case, you are required to So in any case, you report
Okay, sir.
NAV from the. So what you are asking. So if you go back to my instructional video, what you have to capture is basically the. I showed you the account statements in the video, and
Sir, that I have done and submitted.
that is the part where they show you the NAV. So that's what we are looking to capture, the day-to-day movement in the NAV.
Okay, sir.
Okay. So yeah. Okay. Any other question?
Sir, Harsh this side, sir.
Yeah.
Sir, have you received my file?
Yeah. Some of you have asked for, please confirm. If you have shared it through Google Drive, obviously I have received it. There's no. I have replied to those who have asked for confirmation, but
Okay.
it's possible for me to open all the mails right now, because I will open the mails when I start doing the grading.
Okay, sir. Sir, I have one question, sir. Sir, in this ticker which you are showing right now, which is shared on the screen, sir, in September, the uptrend is neutralized.
Yeah.
So, sir, when the new uptrend is neutralized, we have sold the share.
Right.
At that time. And sir, when should we rebuy it? If we want to rebuy it, sir, it is based on our judgment that when we should buy it. It is our judgment.
You missed the last part of the discussion. That's the question that Vipul was asking. So
Sir, I was listening to it, but I'm a bit confused.
okay. So
Yes.
maybe what you can do is I'll just give you a summary. So the short summary of answer to Vipul's question is, Vipul's question is exactly the same as yours.
Yes, sir.
So the short summary of answers to his question is that one option is to rebuy on a break above this high.
Okay, sir.
The second is to use a mean reversion approach against the short-term downtrend. Okay, and focus and say that this downtrend is not sustainable because I'm a mean reversion trader and I have clearance from the high level filter where there is, okay, it's a neutralized uptrend, but it's an uptrend. So
Yes.
I wait as a mean reversion trader as it's coming down. I keep waiting. I don't do anything because I need to have a neutralization of the downtrend before I buy. Remember, we have touched on these things.
Yes, sir. Yes.
Therefore, the time where I go long is on a break above this high, because this is the lowest high from which the new low is made, from which the lowest low is made at any point. The lowest high from which the lowest low is made at any point of time.
Yes, sir.
Well, at this point, it is this. Therefore, I go long on a break of this, which is somewhere around 30th September or something.
Yes.
And I go down here and I put a stop here.
Okay, sir.
Yeah, you can also replay the video. I'll upload the video. And there are 14 people left. So please spread the message. Please notice that you see the video links and then you can subscribe to that. Please notice that it's a different channel now. Okay. So some of you remember when BG sir had banned the recording of videos, I had posted them to this channel. But now so I don't want to go back again and start posting to the other one. So I'll keep it on this channel. So you can just subscribe to the channel or whatever, but make sure it's a different channel so that you'll get notifications when I upload the videos.
Okay.
You as well. Okay.
Yes. Sir.
Okay. Any other question? All done? Okay. Very good. Okay. Great. So I'll see you guys on Monday. Okay. Take care. Bye.